While most headlines were locked onto tariffs, trade tweets, and quarterly market volatility, something far more consequential moved quietly in the background. Capital did not panic. It repositioned. Between roughly 2018 and 2020, the core years of the US-China trade war, an estimated $1.6 trillion in net capital flows shifted away from US-centric exposure and into alternative geographies, currencies, and balance sheets. This was not a crash event. It was a slow, deliberate reallocation driven by incentives, constraints, and risk math. The core event can be defined simply: trade policy uncertainty altered global risk, adjusted return calculations, and large pools of capital responded by moving, not exiting markets, but changing where safe and productive capital lived. That distinction matters. Most observers looked for capital flight signals like collapsing asset prices or disorderly FX moves. They missed the story because prices mostly held. Until later. The flow happened underneath. Why did the crowd miss it? Because retail narratives follow price, not positioning. Institutional capital, sovereign wealth funds, reserve managers, multinational balance sheets, pension funds, and global insurers moves on a different timeline. It responds to policy durability, legal predictability, currency stability, and supply chain resilience. When those variables wobble, capital doesn't wait for confirmation. It hedges first and explains later. The forcing mechanism here was not tariffs themselves. Tariffs were the visible symptom. The actual driver was policy uncertainty duration risk. By mid-2018, average U.S. tariff rates on Chinese goods rose from roughly 3% to over 19% on targeted categories. That alone didn't force capital to move. What mattered was that trade policy became discretionary, headline-driven, and difficult to hedge over multi-year horizons. Long-duration capital, money with 10, 20, or 30-year liabilities, cannot price political optionality easily. When uncertainty becomes structural rather than cyclical, portfolios adjust. This is the part most people miss. Capital doesn't need to hate the US to reduce exposure. It only needs better risk symmetry elsewhere. During this window, Europe stabilized its post-crisis regulatory framework, parts of Asia accelerated regional trade integration, and emerging markets offered higher nominal yields with improving current accounts. Even a 50 to 100 basis point shift in expected real returns when applied to trillions of dollars is enough to justify large reallocations. What was at stake was not just market performance, but control over future financing costs. Capital outflows, especially reserve and institutional reallocations, affect demand for treasuries, dollar liquidity, and cross-border investment funding. These flows influence yields, FX hedging costs, and eventually domestic borrowing conditions. They do not show up immediately, they compound. Now here's where it tightens. Once capital builds alternative plumbing, new custody, new clearing relationships, new supplier financing, it rarely snaps back quickly. The trade war period accelerated diversification away from single jurisdiction dependence. That structural change persists even after headlines fade. To understand how roughly $1.6 trillion quietly shifted away from US-centered exposure during the trade war period, you have to stop thinking in terms of dramatic exits and start thinking in terms of portfolio plumbing. Capital rarely leaves in one direction. It reallocates across instruments, maturities, currencies, and jurisdictions, often without triggering obvious price dislocations in any single market. The first mechanism was reserve diversification. Between 2018 and 2020, global foreign exchange reserves grew from approximately $11.3 trillion to over $12 trillion, but the US dollar's share declined from about 62% to near 59%. That 3 percentage point shift sounds small until you do the math. On a $12 trillion base, that represents roughly $360 billion in reduced incremental dollar allocation. This wasn't mass dumping of treasuries. It was new money choosing different destinations: euros, yen, gold, and increasingly regional currencies tied to trade settlement. This is the first key insight. Most capital shifts happen at the margin. Central banks rolling maturing treasuries reinvested a smaller share into new U.S. paper and redirected proceeds elsewhere. No panic, no headlines, just allocation math. The second mechanism was corporate balance sheet hedging. Multinational firms, especially in technology, industrials, and consumer goods, faced rising uncertainty about tariffs, supplier costs, and retaliatory trade barriers. To manage this, they adjusted cash holdings and capex geography. U.S.-based firms increased offshore cash balances, while non-U.S. firms delayed or reduced U.S. direct investment. Net foreign direct investment inflows into the U.S. fell from about $275 billion in 2016 to under $150 billion by 2019. Again, not zero, but a meaningful contraction. Now here's where it gets mechanical. When a European firm builds a factory in Vietnam instead of expanding in the US, capital does not pass through US financial markets at all. It bypasses them. Over time, that reduces dollar demand, US banking intermediation, and associated fee and financing activity. Multiply that decision across hundreds of firms, and the flow adds up. The third channel was portfolio rebalancing by global funds. Pension funds and sovereign wealth funds manage against volatility targets and long-term liabilities. As trade policy uncertainty increased, the perceived volatility of U.S. earnings in trade-sensitive sectors rose. Even a modest 5 to 10% reduction in U.S. equity or credit weighting across multi-trillion-dollar portfolios translates into hundreds of billions of dollars seeking alternatives. Much of that capital flowed into European credit, Asian equities, infrastructure assets, and private markets outside the U.S. A concrete example helps. Suppose a global pension fund manages $500 billion with a 40% U.S. exposure, $200 billion. If policy risk raises expected volatility and the fund trims that exposure to 35%, that's $25 billion reallocated. Now scale that behavior across dozens of large institutions. You quickly reach the high hundreds of billions. The fourth and least visible mechanism was trade settlement and invoicing shifts. As tariffs disrupted supply chains, some exporters and importers experimented with non-dollar settlement to reduce FX and policy risk. While still a minority of global trade, even small shifts in invoicing currency reduce transactional dollar demand and reinforce diversification incentives. This is the part most people overlook. None of these flows require selling U.S. assets aggressively. They require only not buying as much and building alternatives. Prices can remain elevated while flow dynamics quietly change underneath. Next comes the pressure, because when capital reallocates, someone else must absorb the difference, or leverage must increase. That's where constraints emerge. Once capital began reallocating quietly rather than fleeing dramatically, the real consequences showed up not in prices, but in constraints. Financial systems do not break because money disappears overnight. They strain when who provides funding changes faster than who needs it. During the trade war period, that mismatch widened across several key actors. Start with the U.S. government balance sheet. The United States ran fiscal deficits exceeding $1 trillion annually by 2019, even before the pandemic. That required constant absorption of new Treasury issuance. When foreign official demand grows more slowly, or merely stops accelerating, the burden shifts elsewhere. Domestic banks, pension funds, households, and leveraged intermediaries must absorb the difference. This is manageable only if yields adjust or leverage rises. During this period, yields stayed relatively contained, which implies balance sheet stress was absorbed through increased duration risk and leverage, not price clearing. This is the first pressure point. Someone must hold the paper. When foreign reserve managers marginally step back, domestic institutions are structurally forced forward. Next, look at U.S. corporations. Many firms entered the trade war with elevated leverage after a decade of low rates. Corporate debt outstanding rose from roughly $6 trillion in 2010 to over $9.5 trillion by 2019. Trade uncertainty didn't immediately crush earnings, but it compressed visibility. That matters because refinancing cycles do not care about headlines. They care about windows. Firms facing maturities had binary choices: refinance at slightly worse terms or cut investment to preserve cash. Either way, pressure builds. Capital expenditure slowed, not because money vanished, but because risk-adjusted hurdle rates rose. Now here's where it tightens further. Exporters and importers became trapped between policy and logistics. Tariffs raised costs, but supply chains could not be rerouted instantly. Importers either absorbed margin compression or passed costs downstream, risking demand destruction. Exporters faced retaliation risk that made long-term contracts harder to price. This forced shorter contract durations, higher working capital needs, and greater reliance on short-term financing, exactly the kind of financing that becomes fragile when global liquidity preferences shift. Meanwhile, global banks faced a different constraint: regulatory capital. Post-2008 rules limited balance sheet expansion. As cross-border flows became more complex and less predictable, banks could not simply intermediate unlimited capital reallocation. This reduced market-making depth. Liquidity still existed, but it became conditional, available in calm markets, scarce in stress. The most exposed group was leveraged funds and carry traders, strategies that relied on stable correlations. Long U.S. assets funded by cheap dollar borrowing faced creeping basis risk. Even small moves in funding spreads or FX hedging costs can destabilize leveraged positions. When hedging costs rise from, say, 20 basis points to 80 basis points, returns collapse. Funds don't wait for losses to mount. They de-risk preemptively, reinforcing the flow shift. This is the binary framing. Either capital accepts lower returns to maintain exposure, or exposure declines and the system adjusts elsewhere. During the trade war, the adjustment happened through quiet de-risking, not crisis liquidation. A brief historical parallel helps. In the early 1970s, after the collapse of Bretton Woods, capital didn't flee the U.S. instantly. It diversified gradually as monetary regimes shifted. The difference today is speed and scale. Digital markets and global funds compress adjustment timelines from decades to quarters. The key takeaway is this: pressure does not announce itself. It accumulates in refinancing schedules, inventory cycles, and balance sheet tolerances. By the time prices react, positioning has already changed. At this point, the narrative needs to be proven with arithmetic, not opinions, not sentiment. Flow math. Because capital does not move because it feels uncomfortable. It moves because balance sheets stop clearing cleanly under existing assumptions. Start with the U.S. external balance. Between 2018 and 2019, the U.S. current account deficit averaged roughly $480–520 billion per year, or about 2.3–2.5% of GDP. That deficit must be funded, always. By definition, a current account deficit requires an equal capital account surplus. Foreign capital inflows buying U.S. assets. When trade policy uncertainty rose, the composition of that funding changed, even if the headline deficit did not collapse. Here is the key identity most people miss. If the U.S. still runs a 500B external deficit, but foreign official and long-duration capital slow their purchases, the gap does not disappear. It is filled by shorter duration, more price-sensitive capital. That is not neutral. It raises rollover risk. Now layer in Treasury issuance math. Net Treasury issuance exceeded $1 trillion annually by 2019. Foreign holdings of Treasuries plateaued around $6.6 to $6.8 trillion during this window. That means marginal issuance increasingly relied on domestic buyers. Domestic buyers fund Treasuries through deposits, money markets, and leverage. This works until balance sheets tighten. This is where scenario math becomes unavoidable. Scenario A, stable absorption. Assume foreign demand doesn't fall outright, but grows at 0.1% annually instead of prior 3–5% trends. On a $7 trillion base, that's a shortfall of roughly $140–280 billion per year compared to prior expectations. Domestic markets must absorb that delta. Scenario B, gradual diversification. Assume foreign holders reduce dollar exposure by 2 to 3 percentage points over several years. On global reserves of $12 trillion, that's $240–360 billion redirected elsewhere. Not sold aggressively, but not reinvested into the U.S. Scenario C, private capital pullback. Assume FDI and portfolio inflows underperform pre-2017 averages by $150–200 billion per year. Over 3 years, that compounds to $450–600 billion. You don't need all three scenarios to happen at once. Even partial overlap pushes total flow pressure toward the $1.6 trillion range over the trade war period. That's where the estimate comes from. Not a single data point, but cumulative shortfalls relative to prior baselines. Now connect this to supply chains and trade flows. U.S. imports did not collapse. They rerouted. China's share of U.S. imports fell from roughly 21% in 2017 to about 13% by 2020, while imports from Vietnam, Mexico, and Southeast Asia rose sharply. That reconfiguration required new capital formation outside the U.S. factories, logistics hubs, supplier financing. These are capital intensive. Money followed production. This is the part most people miss. Trade diversion implies capital diversion. You cannot move supply chains without moving financing, insurance, FX hedging, and working capital pools. Those flows bypass U.S. balance sheets almost entirely. Add one more layer, FX hedging costs. As rate differentials widened, hedging dollar exposure into euros or yen became more expensive. For some investors, fully hedged U.S. bond returns turned negative on a real basis. When hedged yield drops below zero, the math becomes binary. Hold for safety or diversify for return. Many diversified. Put all of this together and the conclusion becomes mechanical, not ideological. The U.S. needed sustained inflows to fund deficits and issuance policy. Uncertainty reduced the growth rate of those inflows. Trade rerouting created alternative capital sinks. Balance sheets adjusted gradually, not explosively. This is why normal expectations fail here. People expect capital to react visibly. In reality, it reacts arithmetically, quietly, predictably, and only later does price volatility catch up. Markets rarely react to flow shifts in a straight line. The typical pattern is not capital leaves, prices crash. The pattern is repricing through microstructure. Spreads widen first, liquidity thins next, correlations become unstable, and only then do broad indexes reflect the change. That's why the trade war capital shift looked invisible for long stretches, then suddenly felt obvious during volatility bursts. 2018 Q4, mid-2019 trade escalations, and again into 2020's shock environment. Start with the most important transmission channel, liquidity quality. A market can be liquid in calm conditions and illiquid in stress. During the trade war, the US remained the deepest market in the world, but the marginal buyer became more price sensitive. When foreign reserve managers and long-duration allocators slow down, the buyer base tilts toward entities that require compensation, banks constrained by balance sheets, hedge funds that trade basis, money markets that care about funding conditions. This doesn't guarantee a sell-off. It guarantees fatter tails, more frequent episodes where liquidity vanishes at the wrong moment. This is the part most people miss. Price is not the first signal. Spreads are. In stress, the bid-ask spread on credit instruments widens, repo rates move, and swap spreads behave strangely. Those are the early warnings that the plumbing is straining. The second channel is volatility regime shifts. When policy becomes less predictable, options markets price higher implied volatility. That raises hedging costs. Higher hedging costs force de-risking. De-risking reduces liquidity. Reduced liquidity increases realized volatility. The loop reinforces itself. Even a modest rise in implied volatility, say the VIX drifting from 12-14 into 18-22, changes risk models across systematic funds. Many risk parity and volatility targeting strategies reduce exposure when realized vol rises. That selling is not opinion-based. It's formula-based. Now here's where it breaks for observers. Those sales can happen on good news. Markets rally, volatility rises, and systematic strategies still cut risk. To retail eyes, it looks irrational. Structurally, it's logical. Third, correlation breaks. In stable regimes, investors assume diversification, stocks down, bonds up, risk-off flows into treasuries and the dollar. But when the story is about funding composition and policy uncertainty, correlations can flip temporarily. You can see equities wobble while the dollar strengthens, or credit spreads widen even as headline indices hold up. That happens when the market is not pricing growth, but pricing financing conditions. A fourth channel is basis and funding stress. When the system relies more on short-term funding to absorb issuance or positioning, small disruptions matter. Repo rates moving 25-100 basis points in a short window can force leveraged players to cut positions. The 2019 repo episode is a good example of how quickly funding conditions can tighten even without an official recession. When funding costs jump, the market transmits that stress through forced selling, not because fundamentals collapsed, but because financing did. Fifth, you get premium discount divergence. ETFs can trade at discounts to NAV in stress. Treasury futures can deviate from cash bonds. FX forward points can shift rapidly. These are all symptoms of the same thing. Intermediation capacity is finite. When balance sheets are constrained, arbitrage becomes expensive, and mispricings persist longer. So what should observers watch in this type of environment? Not headlines, not vibes. Watch the plumbing indicators. Credit spreads, investment grade versus treasuries, high yield versus treasuries, repo, funding rates and signs of stress in short-term markets, swap spreads and treasury market depth, yield curve shape, term premium and inversion dynamics, dollar index, DXY, and FX basis hedging costs, equity volatility metrics, VIX level and term structure, ETF flow data, and persistent premium discount behavior. The reaction may look irrational because the market isn't reacting to one piece of news. It's reacting to a slow shift in who is willing to warehouse risk. When that shifts, markets reprice the cost of liquidity itself. Now here's the mini cliffhanger. Once liquidity becomes conditional, the timeline matters. You can go months with calm markets and then experience 2 weeks where everything reprices at once. That is not randomness. It is the system catching up to accumulated flow pressure. By the time capital has already shifted, the future is no longer about whether the system adjusts, but how it does so over time. Markets do not resolve structural flow changes instantly. They process them through timelines, funding cycles, refinancing calendars, policy responses, and behavioral thresholds. Understanding that timeline is the difference between being confused by volatility and understanding it. The timeline framework short-term, next days to weeks. Next days to markets react to signals, not outcomes. Funding rates, FX basis, volatility term structure, and credit spreads adjust first. Prices may look calm, but internal stress builds. Medium term, 1 to 3 months. Positioning adjusts. Systematic strategies rebalance. Corporate treasurers alter hedging behavior. Issuance windows open or close. Liquidity conditions either stabilize or deteriorate rapidly. Longer term, 1 to 4 quarters. Real economic effects emerge. Investment decisions change. Supply chains harden around new geographies. Capital plumbing becomes semi-permanent. Reversals become expensive. That's the structure. Now the scenarios. Scenario 1, base case. Slow absorption. Higher fragility. This is the most likely outcome. Capital does not flee the U.S. but remains selective. Foreign demand for U.S. assets grows slowly or stays flat. Domestic institutions absorb incremental issuance. Markets function, but with thinner margins for error. In this scenario, Treasury yields fluctuate within ranges, but term premium stays elevated. Credit spreads widen modestly, not crisis levels, but persistently above cycle lows. Equity markets remain volatile, but range-bound. Dollar strength becomes episodic rather than dominant. Confirming indicators, credit spreads holding 50-100 BPS wider than prior cycle tights. Repo and funding markets stable but sensitive to issuance. VIX rarely returning to ultra-low teens. Continued diversification in reserve composition data FDI inflows below pre-2017 trend averages. The system holds but becomes less forgiving. Small shocks matter more. Scenario 2, stress case, liquidity. Tightening forces, repricing. This is what happens if funding conditions tighten faster than balance sheets can adapt. Triggers could include sharp rise in issuance without matching demand, policy missteps or renewed trade, geopolitical escalation, a funding market disruption, repo, FX swap lines, or credit events. Here the system faces a binary choice. Prices adjust or leverage breaks. In this scenario, Treasury yields may fall initially, then spike due to supply funding stress. Credit spreads widen aggressively. Equity correlations rise toward 1. Everything moves together. Dollar funding stress appears via FX basis. Confirming indicators. Rapid widening in high yield and investment grade spreads. Persistent repo volatility or emergency liquidity measures. ETF discounts and cash futures dislocations, sharp steepening or violent curve moves, accelerating outflows from leverage strategies. This is when the market suddenly realizes what was building slowly. Scenario 3, relief case, policy stabilization and capital rebalancing. This scenario requires clear, credible stabilization, not optimism. It would require durable trade frameworks or multilateral agreements, predictable fiscal and monetary coordination, reduced uncertainty around supply chains and regulation. In this case, capital doesn't rush back, but stops diversifying away. Outcomes. Volatility compresses, hedging costs decline, FDI and portfolio flows gradually recover. Markets reward predictability over growth narratives. Confirming indicators. Narrowing credit spreads with rising volumes. Sustained improvement in FDI data. Declining FX hedging costs. Stable issuance absorption without stress. Volatility. Staying low without liquidity. Interventions. This is the slow repair path. The big picture takeaway. The most important conclusion is not about the trade war itself. It's about market structure. Capital today is mobile, conditional, and duration sensitive. It reacts not to headlines, but to policy credibility, balance sheet math, and risk symmetry. When uncertainty becomes structural, capital doesn't protest, it repositions. That repositioning, spread over years, across instruments, and through balance sheets, is why the $1.6 trillion shift didn't look dramatic in real time. But it mattered, and its effects linger long after the news cycle moves on. Markets don't break because money leaves. They strain because the wrong money is left holding the risk. Final disclaimer. This content is for educational purposes only. It is not financial or investment advice. All markets involve risk, uncertainty, and the potential for loss. Scenarios discussed are illustrative, not predictive. Always consult qualified professionals before making financial decisions. If you found this breakdown useful and want ongoing, mechanism-focused analysis like this, consider subscribing for future updates.